Hey everyone, welcome to another episode of the Brick+Work Podcast. Our guest today is Zach Streit, with the Senior Vice President and member of the Davies Group at George Smith Partners, who arranged debt and equity financing for commercial real estate sponsors. The group's track record exceeds $4 billion in closed volume to date. Welcome, Zach.
Hey, thanks, John. Thanks for having me. Appreciate it.
Yeah, thank you for agreeing to come on. I know this was super short notice, but I think it's going to bring value to everybody. So, and I want to learn from you, really. So, self-serving as well, inviting you on here. But just very non-formal. Just want to start from the beginning. If you want to kind of share a little bit more about where you grew up, and then what brought you into LA, if you're not originally from here, and in commercial real estate finance.
Happy to share. And I definitely have maybe a circuitous path and maybe the road less traveled. But I grew up here in LA, in West LA, so I'm a native.
Nice.
And naturally, because I grew up here, when I went to college, I wanted to get as far away from my parents as possible, both physically and professionally. So I ended up going to school in New York for undergrad, and I wanted to do anything but real estate because I grew up in a family that did a lot of real estate. And so I ended up majoring in political science at Yeshiva University in undergrad. And I did what all poli-sci majors did. I went to law school, and it wasn't until I was sort of in law school that I started taking real estate classes, and I realized, hey, I actually really like this. It speaks to me a lot more than real estate. But stubborn me, I had to learn the hard way. And look, it was great. I'm a big believer in critical thinking, and I eventually graduated law school and passed the bar. And a mentor of mine told me, hey, you're going to turn 30 with or without the bar and a law degree, so you might as well do it. And so I did it, and I'm thankful because it's shaped who I am, and it's informed our practice a lot, and I think that's great. But I ended up spending a decade in New York, the first decade of the 2000s. After I graduated law school, I enrolled immediately in NYU's Masters of Real Estate program. And I knew that I wanted to do something in real estate finance related. So much so that my second year in law school, instead of getting a job at a big firm, I actually ended up interning at Vornado, which is a big REIT in New York City that's been in the news lately because they just signed a big tech lease at the Farley Post Office building, which is a big deal, because a lot of people thought that big tech leases would not be getting signed going forward, and that everything
Facebook, right? Also in New York just recently.
Also in New York, the epicenter of COVID. So that really planted the seed for me, and then I knew I had to do it. And so I enrolled in NYU's program in September of 2007, and I had a job by the end of my first semester, and lucky me that I did, because that was the onset of the
real estate crash.
So I started my first job in January of 2008, let's say, and I spent about 3.5 years working for a big UK insurance company called Aviva Investors in one of their equity groups. Mm-hmm. And then I moved home. So, it took me going to New York, and then I shifted to real estate in New York and was able to move home. I came back and I worked as a lender for about 5 years, for a few years with my family, setting up and running a bridge and hard money lending platform. And then I worked at Colony Capital for a year in one of their specialty groups that wrote CMBS loans on single family rentals. And then I worked briefly at Anchor Loans, running their originations team. And I've been at George Smith Partners for about almost 4 years now. And I think when you look at it at a big picture, I for sure took the road less traveled. I had to go to New York to appreciate LA. I had to be outside of real estate to appreciate real estate. I had to be on the principal side for about 9 or 10 years. To appreciate being an advisor. And that probably is really the road less traveled, because there are very few people that go from principal to advisor. Most folks go from advisor to principal. But in all my years as principal sort of informed my practice as an advisor. It's the reason in part that, our team was so successful last year. And obviously I work with Malcolm Davies, and he's amazing. And he and I together did $1.3 billion last year. We did about $800 million the year before.
Yeah.
And part of it was just the background. He was a developer, and he brings that to bear in our practice. And I spent significant time on the equity and debt side, and I can kind of bring that into our practice. And so it all sort of comes together, but it kind of comes together in a way that you wouldn't expect and you wouldn't foresee. And so if there was any advice I had, since you mentioned learning, and I don't know, I'm still young to be giving advice, but I would say to folks out there who are listening, don't dishonor anything that you do, because the stuff that you're doing right now could inform what you do in the future in a way that you can't foresee. And I would say that's doubly true during a pandemic, when there's way more uncertainty out there than has been in many people's careers, and certainly in the last decade. And there's sort of a reason for stuff. So if you just, keep pushing and you just keep working hard, it all kind of comes full circle.
That's great advice. And so I just want to touch upon something quickly that you said too, which I didn't catch until late last night, which is really, so, I started in loans as well, but more of a residential mortgage side, right? And same time, the crash 2009 is when I entered, and there was no volume. I spent a year with my laptop in the car, driving around to realtors that weren't doing anything and asking for business. So that's where I came from. But, eventually that led me into taking my real estate broker license, doing some real estate, but mostly getting into commercial loans and ground up. And so I actually spoke with Ari and Nava. So they're and not only that, but I sent them loan scenarios, and all of a sudden, because just I have some developers initially for ground up stuff and smaller, like within the 5 million range. And I remember one of them got my LinkedIn and was just like, "What is Brick+Work?" And I sent them a sample, and they're like, "This would be awesome for us to use to underwrite deals," right? Especially when it's just land and the developer's going, we're going to build X amount of units. We definitely need this for us. And so they actually have a Brick+Work account. I just thought I'd throw that out. I just didn't know that.
Very small world. And look, I echo that. You have the family's, rubber stamp behind what you guys are producing. I spent a little time on your website too. And, your services aren't just valuable to developers. They're valuable to all manner of service providers, whether they're lenders, debt and equity finance advisors like us. I'm sure attorneys, because there's
we've had attorneys reach out too, but as developers themselves, as principals, not necessarily,
no, very awesome. Small world.
So my next question, now here's the learning portion, is so coming from me, just doing commercial loans as well, the obviously owner operator, brokering to banks, those are kind of an SBA or something that I've already kind of gotten accustomed to. Now, the equity portion, I want to see maybe if we can all learn, because I know there's people in our audience that are even real estate agents and brokers that aren't familiar with going up higher in the capital stack, what a capital stack means, what are the terms being thrown around, that's preferred equity or senior debt or mezzanine. So if you could kind of, you don't have to go so much in detail, but just kind of a lay of the land for everyone on what that means to go up into equity.
Sure, happy to. So, let me back up. And, for those that don't know me and George Smith,
please.
I can talk just briefly about the company and then kind of what we do. So we're debt and equity finance brokers. So we focus on the finance side of real estate only. So we don't do investment sales or leasing. We're pretty pure in our focus. And the company does about $3 billion a year in production. I work, as you said, as a member of the Davies Group together with Malcolm Davies, and we have the biggest team in the shop and have been the biggest producing team in the shop last couple of years. So we're proud about that. Our focus is really helping entrepreneurial sponsors get their institutional level deals capitalized. So we focus on middle market sponsors, let's say, that tend to be doing large deals. I would say the average deal that we work on is probably $40 to $50 million, and we can dip down as low as 10 million. And last year we closed the biggest deal in our firm's history. It was a $600 million deal for a ground up high rise that in downtown Portland that included a Ritz-Carlton hotel, residences, and office space.
Congrats on that deal.
We're proud of that. That was pretty momentous. The reason I preface with all that is our sponsors tend to have needs that are both on the debt side and on the equity side of the capital stack, and we spend time in both. On the debt side, most of them are focused on non-recourse financings,
right.
And not always, but a lot of the times they want to get high leverage situations because they have syndicated equity in their deal.
Right.
They have a family office equity partner in their deal that will allow them to utilize leverage, maybe unlike a traditional private equity fund equity source out there that might, sort of cap your leverage at 60 or at 65%. So oftentimes they'll call us up and they'll say, hey, we need you to find high leverage financing. So what are our options? So backing up, prior to COVID, you had a lot of what we called stretch senior lenders that were out in the marketplace. And those were essentially debt funds that were offer non-recourse, construction and bridge executions that were pretty high leverage. You could, before COVID, get, up to 80, 85%, sometimes even 90% loan to cost on large deals, non-recourse. And look, those last dollars get expensive because as lenders get higher in a capital stack, the debt begins to feel more like equity. So you pay for it. But, look, if you look at playing an equity debt provider, 9, 10% plus or minus versus what the equity is going to cost you, especially after its upside participation, there are reasons to do that. Today, a lot of those stretched senior providers are still on the sidelines, and we've gone back to a more traditional high leverage structure when we get guys that need leverage, which is basically a lower leverage senior bank loan, and then mezzanine or a preferred equity provider on top of that. And so we actually put a deal into application in downtown LA. It's about a $100 million deal and needed about $75 million of construction debt. And so we asked about a $50 million senior loan and a $25 million really preferred equity piece or mezzanine loan. We tend to use the term somewhat interchangeably. They're not exactly the same, but they're close. Get to the borrower's last dollar need of $75 million. And that's a 235 unit ground up multifamily deal. And look, I think that's significant for two reasons. One, construction deals are still getting done. And two, you can still find fairly aggressive leverage. You're not finding the 85 and 90% that you found pre-COVID, but you are getting up to 75%. And on some other deals, we've even seen leverage getting pushed to 80% within the multifamily space. So that's still out there. So, when we talk about kind of mezzanine and preferred equity, we're talking about sort of high leverage debt. That's debt with a fixed coupon. In the case of mezzanine financing, it's actually, on title and secured by a pledge of the equity and a UCC filing. Technical, if you're talking about preferred equity, you're actually in the operating agreement. But both are junior to the senior loan and both are senior to the equity. So it kind of fits into a wedge in the middle of the stack. That is very different than common equity. Common equity or traditional joint venture equity doesn't have a debt-like position, and is really sort of riding, generally, alongside general partner, alongside the sponsor. It may get a preferred return before the sponsor gets into its promote, but it doesn't get a fixed return the way debt does, and it does participate in the upside in a way that debt usually doesn't. So I would say those are the kind of the key differentiators between kind of subordinate financing and equity that's out there. Just go on quickly. I'd say that, when we do spend time in the equity markets, pure equity markets, we work on a lot of opportunity zone equity deals, since those are still getting done today. And they're
the funds, right?
Capital. The funds. And then we still continue to do traditional limited partner equity, which is tougher today, and a lot more selective and very focused on recapitalizations and distressed opportunities. And then we're still active in the co-GP equity space, which is a space where if a developer needs capital injected into its GP, or maybe a developer needs a balance sheet to help credit enhance its loan.
Happens more frequently than you think.
A lot of guys need it. Need it. Kind of helpful in pairing up groups like that. So, because so much of our work is transitional, and because we're working with transitional sponsors that are doing large deals, those are often the needs. So those are the areas that we try and focus on.
Got it. So, that is a perfect segue, I think, now kind of tying in Brickwork and George Smith is so I touched upon this before, but
Mhm.
and you also, I want to take a deeper dive. So essentially, just to set the table, what we've been noticing, because we're talking to developers too at the same time with brokers, because
Yeah.
we're acting as a land use consultant or an attorney for hire on demand, cheaper than what you would actually pay the attorney, right? So that's kind of our value add for now.
Right.
And by providing that extra advice about clarifications on a bunch of different things, what we've also seen our brokers use the reports for is really prospecting for off market, would have never added that listing, multi-generational, multi-family office owners of a bunch of these properties that, it was never in the business plan to sell or joint venture, if that makes sense,
Right.
right? Why would
Right.
they, right? It's a great source of passive income. They could keep that in the family, and it could just, right, generate income
Yeah.
without paying too much tax. But what's been going on, obviously, post-COVID, is that they're starting to review some of their portfolio, and not all of them, but of course, not everything in their portfolio is like, you know, A grade, you know what I'm saying? Like just generating income and not worrisome. There are actually some properties that, dependent on the tenant mix, are a bit worrisome and concerning, right? On both ends,
Right.
bank end and also on the lease end. So,
Sure.
they're now, and I've been on a few of these conference calls as, oh, who's Brickwork? Are you sure this report makes, right? So that's really my role in that conversation. But so, I've been privy to hearing this, and they're just like, look, we would have never done this, but we want a joint venture like what you talked about,
Yeah.
right? Where it's just, we'll put the land up, you guys build these at scale, let's get together. This feels like the highest best use for this property at this time, I guess, right?
Yeah.
Very so let's talk more about that. And I know you said that was a great opportunity. What are some challenges you see there, or how does George Smith kind of can play a role in some of those deals too, where maybe
Yeah.
they started off, but the developer now doesn't really have all the equity to make sure that it's built, even though there's
Yeah.
land to play, right?
Yeah. So look, a lot of great points in what you're saying there. I think, from a prospecting standpoint, folks could use Brickworks to, go to landowners and say, hey, or property owners and say, hey, like the highest and best use of your property isn't being achieved.
Right.
Here's what it is,
Mm-hmm.
and here's the number that, I think I could get, or here's a partner who, you contribute the land and they'll fee develop,
Mm-hmm.
or maybe they'll become your partner, but they'll manage all of the development.
Right.
Or, hey, they'll manage it, and here's George Smith, and they'll help you put together the rest of the capital stack. The downtown LA deal that I mentioned that we just put in application is probably a good example of this. So the sponsor on the deal approached us, and his family actually owned this piece of property in downtown LA for like 50 years. I mean, they've owned it for a long time, and
Yeah.
clearly it's appreciated a ton in that time frame.
Mm-hmm.
And they ended up getting pretty lucky because the land ended up being in an opportunity zone. It's south of Pico in downtown LA. And so when he first came to us last year, he said, look, I've got this piece of property. It's an heirloom, been in our family forever.
Mm-hmm.
We know we are not utilizing the highest and best use.
Mm-hmm.
We'd like to develop a 235 unit, mixed use apartment building on it. And we need help. And we need help in different facets of the stack. We need help arranging a co-GP.
Mm-hmm.
We don't really have the balance sheet to sign for such a large construction loan, which we talked about with $75 million in financing.
Yeah.
That's a lot of pennies. So
Mm-hmm.
we need to have a big balance sheet to get the lenders comfortable, with a completion guarantee, and that the sort of credit enhancement is there. So we brought in a good partner of ours that we've done a lot of business with to be the co-GP on that deal. The sponsor said, hey, we need a little help putting op zone equity groups together that might be interested. And so we helped out with that and made a bunch of introductions for the sponsor. ultimately on that deal, they had a pre-existing relationship that they brought in, but we were happy to help with that and support, and also make a bunch of new introductions for the sponsor.
Yeah.
And so now in their next deal, they really are going to know everybody within the OZ landscape, which I think is super helpful because, as I mentioned before, opportunity zone equity funds continue to be a fertile source for multifamily and for industrial development. And so, that equity source certainly isn't dead, contrary to some popular beliefs. And then they came to us and they said, look, we need some high leverage construction financing, which is unusual in the context of opportunity zone deals. Generally, opportunity zone funds want to put more equity in and not less.
Yeah.
And generally, like the traditional private equity funds, they want to limit a developer to probably utilizing, 60 or 65% loan to cost financing. In this case, we were able to exceed 70. And I think it's because the deal is so large. It was, $100 million deal, let's say. And so in that case, the opportunity zone fund said, look, I can earmark 20 or $25 million to this deal and no more. And so we need to utilize leverage to get there. But I think that's a fantastic example of something that, folks could think of Brick+Works for, because this sponsor knew that the highest investment wasn't, being achieved, and he had sort of a plan. And maybe it's a good example of how folks can kind of use us because the sponsor had that plan, but had never done a deal, on his own that was this large. He had a lot of experience doing big deals as part of a prior firm. But like this was his sort of first venture on his own. And that's normal for our profile. We get, guys that are sort of ex-institutional guys that spin out. We work with guys that are sort of just pull themselves up by their bootstraps. We work with some family offices that are actually sponsors on their deals. And, so if they're entrepreneurial sponsors, we're pretty entrepreneurial guys. That mesh tends to work really well for us.
That is awesome. Yeah, that's I see that as a key component or a missing piece. Not dependent on the real estate broker that's kind of brokering that deal. They don't necessarily might not have that kind of game plan and those connections and make right. So you're actually a critical piece in those negotiations. So I think we'll talk on some synergies after this one. I already see them right now. So
one thing I'd add and throw out there is that we actually closed a $30 million land loan in the Tri-Cities that was a pre-development land loan for multifamily during the height of COVID.
Yeah.
And another land loan in Chinatown just last week. And that again was pre-development for multifamily. And we're working on a third in Koreatown right now. So to your point, to those folks that, might be looking to sell their land, or might be looking, for pre-development, financing on land that's earmarked for multifamily use, that market isn't dead either. There's a lot of kind of belief out there that, the capital markets are completely, dead, and that we're, back in 2008, and this sort of correction that we're undergoing, the pandemic, it has been difficult for sure. And the capital markets aren't what they were in February, but they're not dead. And for multifamily and industrial plays, they're still very much alive and well, even to the point where you can get land financings done, which is usually the first area that dries up during a recession because land is illiquid and not cash flowing. So it's kind of interesting.
Absolutely. So, there's a competitor of ours that when we obviously looked at the landscape and figured out how many other companies are doing this, we found a company obviously up in San Francisco because they're always kind of leading the charge on anything. But New York has one, but they're more focused on air rights. And then Miami was its own different animal and company. So, and then the politics there are completely different than here in LA, I'm sure. But one of the companies was called City Builder, and they're out of Seattle, but their approach was unique. They went and their tagline on their website was more, as a landowner, your home could be worth more to a developer. So their initial kind of, strategy was to go for landowners, right? And just say, and homeowners, and just be like, look, you might not know the inherent zoning you're sitting on, but it could, if you were ever to sell it, I know it's not the first thing to think of selling it to a developer. You're always just going to call your local realtor, put it on MLS and Zillow and sell it that way. So I thought that was a really good, unique, but I realized that they didn't grow as fast because it kind of tracked them since we even launched. And that was just because, we're going for the people that are actually tip of the spear, moving transactions, which are the brokers, right? They're really kind of setting conversations and stuff. So we went on that front, but, coattailing off this topic, I think we now need to start to market to landowners, right? But more on the commercial side, more like exactly what I just talked about is I realized that a few of the multi-generational, multi-family, like 6 families together that own 100 properties or so, right? And a lot of them locally here was one of the firms we spoke with. It might be a good time for us to market to them to be like, you might not necessarily know what highest and best use. So we're always a good start of that conversation, and then you and George Smith would be a perfect kind of, okay, well, we have the blueprint on exactly how this could go, right? And so, fit in broker or not, a lot of this would be great. Okay, so just, I just thought of that. It just makes more sense.
No, look, that most of our clients are developers or redevelopers, guys executing on either value-added or opportunistic transactions. And so the type of data that you're offering would be huge for them, because it just makes assessing new projects that much quicker, that much faster. It's leveraging technology in kind of an interesting way. So I think a huge fit.
Absolutely. So we're just coming at the tail end of this. And so I just wanted to have this kind of open-ended question for you because, you work and you have so much insight on a lot of moving parts when it comes to commercial real estate. That's not front and center. That's why I really want to invite you, because I think our typical guests have been brokers and developers. And of course, they're kind of sharing their unique perspective on deal flow and sponsors and how they prospect and all that, and what they're developing and why, right? So we've gotten kind of those questions a bit answered so far. But now this institutional family office side, where you're looking at a little bit more, I would say, complicated financing structures. And it seems like if you aren't doing it, it's tough to grasp, is what I'm trying to say, right? So if you have something you want to kind of share with the audience, and again, we're hoping our audience is just mainly already doing commercial real estate in Los Angeles, but we're starting to pick up a lot of users that are in the residential space that also want to learn. And the barrier of entry has always been information, I think, in commercial real estate. So whether it's the complex financing that you're dealing with, or it's land use and zoning, these are things that have been difficult for them to traverse, to even attempt to work in both fields. So anything you would like to share, insight or advice, or the floor is yours.
Sure. No, look, I appreciate that. That's that's a lot to bite off, and I don't know if I'm an authoritative source or old enough to be giving that kind of advice. I think here's what I'd say from my experience. Number one, whether you're evaluating your first commercial real estate project or you're doing large and complex projects, you'll want to get your service providers input on deals early. And that's primarily attorneys and brokers. And if it's a development deal, it's your architects and your GCs. You want to get them involved early. You don't necessarily have to start running up giant bills early, but you definitely want to sort of bounce your project off of them as early as you can. And that, entails building a good network of service providers. And frankly, mentors are key, especially for the folks that are first starting. And you want to try to have a mentor in the space that is somebody that you would like to grow into, and you might want to bounce your project off them, because the collective knowledge between your service providers and your mentors can really be the difference between running around like a headless chicken and being able to zero in on a project that actually pencils and actually works. So, I would say, number one, build that network, leverage that network, utilize it, as much as you can. That's probably my first piece of advice. My second piece of advice is going to sound a little rudimentary, but I think it's true. And I think it's sort of been heightened. There's so much data that's been thrown at us now in that technology age and in the COVID era, when we're spending so much time at home and screen time, and And I've often thought like, gosh, I'll read one article 1 minute, and then the next minute I'll read another article, and the two will be diametrically opposed. There's just never been more disparate data. And I don't know if I'm getting older and so I'm sensitive to it more, or it's just sort of heightened by the environment that we're in.
Yeah.
But my second piece of advice is you got to trust your gut.
Yeah.
You got to go with your nose.
Great.
After you leverage your network and your service providers and your mentor and anybody else that you talk to, and try and talk to everybody, you know, everything about your deal, because you don't want to lose it.
Yeah, exactly.
Learn as much as you can. But at the end of the day, you've got to distill down what you've learned, and you've got to trust your gut. And if your gut tells you this is a good pursuit, a good deal, I believe in this, and no matter what happens, I'm going to make this happen, you've got to go for it. You know, you've got to go for it, because there is nobody more in tune with your project than yourself, and there's nobody that has more riding on your project than yourself. So, you know, there's probably many other things I could say too, but if I had to distill it down, it's, you know, leverage your network and go with your gut. And if you do both those and you do it well, I think that those are, you know, key components of long-term success.
I think that's the best advice that anyone shared. Maybe I shouldn't say that publicly here, but yeah, those are awesome. And one thing and last thing I want to touch upon is what you had mentioned about critical thinking. And that really stuck in my head, because it seems like what you're talking about with two, you know, articles with, you know, they're at opposite spectrums and they're making valid points, and you could kind of go, well, which of the two, right, do I agree on, right? And I think that speaks to what's going on just socially and kind of politically in America, is that you have this, you know, social media becomes an amplification for some opinions of maybe a few, but then now they're in everyone's face. It seems it's the same thing. There's no few and many at that point, right? If you have the application, it's always in your ear or you're seeing it. What you talked about critical thinking is something I think we're missing. Is I think a lot of people, you know, whether they you know, consume content via an algorithm that feeds them into that deeper and deeper hole, and they come out of it thinking the earth is flat. And there are conventions out there. I mean, you've seen the Netflix special, but there are flat earth conventions, right? Where they have models and everything. So where is critical thinking in all of this? Is, you know, law school definitely teaches you that, but I think in general, I think there has to be a minimum amount of critical thinking that's been missing.
I couldn't agree with you no more. And you know, our practice is maybe a good example of this. We tend to run really hard. We tend to set a really fast pace. You know, we want our clients to know that, you know, we are the most responsive out there, and that ultimately we care the most. But part of what we've learned is that, you know, the frequent, consistent communication is super important. Right. But there are also times where you want to step back and say, okay, this is pretty complicated. I need a minute here. We need to discuss it internally. I need to digest it. I got to go talk to my analyst. This is a pretty complicated Excel model, or, you know, you guys have proposed something that we didn't think of before. Let us digest it and let you know if it's a good thing. So it's a struggle. And I think it's more a struggle in the COVID era than it's ever been, because, you know, we aren't traveling the way we used to. We aren't going to conferences the way we used to.
We're not socializing the way we used to.
Right. We're behind screens a lot of the time. But I would urge folks, and maybe this is the third piece of advice, is that, you know, in trusting your gut, you know, make sure that you spent time and that you've really thought through, and that you aren't rushing big and important decisions. You don't want to lose too much time, because the old saying, time kills all deals, is true. And when guys drag their feet and are not motivated, you know, bad things tend to happen, unfortunately. But there's a difference between dragging your feet and actually spending time and critically assessing, you know, should I turn right or should I turn left? You know, do I go straight? And so I think there's a time for that. And I think that's always hugely important. And sometimes I have to tell myself, okay, hey, wait a minute, you're pushing too hard here. Step back, you know, how else could you think about this? And that takes time, and that's okay. That's not time wasted, you know, in your day, in your clients' days, in your investors' days. Believe me, that's time that's going to be returned to you tenfold, because it's going to save you from running around like a headless chicken over here because you spent a few more minutes over here. So I think great point, John, and it's one that is sort of easily lost right now.
Absolutely. Zach, you amazing. Thoroughly enjoyed this conversation. I've
Likewise.
learned a lot. I'm sure our viewers and audience have learned a lot, and
So,
we'll be reaching out to you. So,
great.
Zach, really thank you so much for this
Likewise.
conversation. This was so
Likewise.
awesome.
If you
Okay.
talk to my siblings before I do, tell them I said.
I have a deal in play. They got to respond back to me.
There you go. All right,
Awesome.
John, take
Thanks so
care.
much. Okay.